You know, when people talk about Warren Buffett, they make him sound like some kind of financial wizard, like he's got this secret code or a superpower that lets him see the future. But the real story behind his success, it's way less magical and honestly, a lot more useful for the rest of us. Here's the thing. Buffett's edge isn't about being a genius. It's all about his process. It's a pretty small set of repeatable business principles that he applies with just extreme patience, and he protects it all with incredible emotional discipline. So today, we're going to break down the Warren Buffett way into a simple playbook you can actually understand and maybe even use. So, where did all this begin? Well, it wasn't in some fancy boardroom, that's for sure. It all started with a mistake he made as a kid, a mistake that completely shaped his entire approach to investing for the rest of his life. Okay, picture this. Buffett is just 11 years old. He'd saved up money from little odd jobs and side hustles. He's studying price charts, and he finally buys his first stock. And what happens? The stock dips. He gets nervous. It comes back up just a little bit, just enough for him to get out with a tiny profit. And boom, he sells. He made $5. And then he had to watch as that same stock absolutely skyrocketed. That one painful mistake taught him two lessons that stuck with him forever. First, don't get obsessed with the price you paid for something. And second, don't sell a good thing just to lock in a small, quick win. In other words, he realized the game isn't about being right today. The real game is to own great businesses for long enough to let that magical power of compounding really do its work. Now, this is where Buffett's story gets really interesting. His philosophy didn't just appear out of thin air. It actually evolved over time thanks to a few key influences, and one really big shift in his thinking. His first major influence was, of course, Benjamin Graham. Now, Graham was the one who taught Buffett to treat stocks like you're buying a piece of a real business, not just a lottery ticket. He's the guy who came up with the idea of buying with a margin of safety. What does that mean? It means you don't buy something because it's exciting, you buy it because you are getting way more value than what you're paying. Graham's whole mindset was defensive. Rule number one, don't lose money. And rule number two, don't forget rule number one. So, early on, Buffett learned to be a bargain hunter, to look for these cigar butt companies that were trading for less than they were worth. But then he met his second big influence, Philip Fisher. See, Fisher cared less about finding a bargain and more about finding incredible quality. He believed that a truly great business, a castle, could be worth paying a fair price for. And that idea got even stronger thanks to Charlie Munger, Buffett's legendary partner. Munger was the one who really pushed Buffett to graduate from buying cheap cigar butts to buying wonderful companies with real long-term strength. And if there's one story that perfectly captures this massive shift in thinking, it's the purchase of See's candies. See's wasn't a classic bargain bin find at all, but it had something that Graham's spreadsheets couldn't really capture. It had a brand that people absolutely loved. It had pricing power. It had incredible customer loyalty. And it had consistent, reliable profits. This was a business that could just keep on compounding year after year. That's the Buffett evolution right there, from a focus on cheapness to a focus on quality, all while never, ever losing that core discipline. So how does Buffett actually go about picking these businesses? Well, his method really boils down to a set of core checkpoints, which act as a pretty simple but powerful filter. First up is the business understandable. Buffett famously avoids businesses he can't explain in simple terms. This is that whole circle of competence idea. You don't have to be an expert in everything. You just need to know what you know and stay inside that circle. Second, does it have a proven operating history? He's not interested in one good year. He wants to see consistent performance over time. And third, does it have favorable long-term economics? And this third point is where the real magic is. Buffett is looking for businesses that can keep spitting out returns without having to constantly reinvent themselves. He's looking for durability. He's looking for what he calls a moat. Now, what's really cool is how these moats can show up. They can come from a powerful brand, from network effects where the service gets better as more people use it, from high switching costs that lock customers in, from huge cost advantages, or even from government regulation. But the core idea is super simple. A great business has a way to protect its profits from the competition. Next on the checklist is management. Buffett isn't just buying numbers on a page, he's investing in people. And he looks for three specific things. One, are they rational with how they allocate capital? I mean, what do they do with the company's profits? Two, are they honest with their shareholders? Do they admit their mistakes or just feed you corporate fluff? And three, are they independent thinkers? Do they resist the herd mentality and stay focused on the fundamentals? You see, a brilliant business can still be run into the ground by bad leadership.
And then, of course, we get to the financials. Buffett focuses on signals that point to real quality, not just market hype. He wants to see strong returns on equity, especially when it's achieved without taking on a mountain of debt. He's looking for healthy profit margins, consistent earning power year after year, and real growth in what the business is actually worth, its intrinsic value, not just growth in headlines.
So the most crucial point here is to change your mindset. You're not buying a stock ticker that wiggles up and down on a screen. You're buying a piece of a business, a stream of its future cash. Okay, so this brings us to how you deal with the market itself, the part where almost everybody gets tripped up. To navigate all the chaos, Buffett uses this famous mental model he got from his mentor, Benjamin Graham. It's the story of Mr. Market. Imagine you own a piece of a business, and you have this partner named Mr. Market. Every single day, he shows up at your door and offers to either buy your shares or sell you his. The thing is, Mr. Market is a bit manic depressive. Some days he's totally euphoric and offers you an absurdly high price. Other days he's deeply depressed and offers you a ridiculously low price. Your job is not to follow his mood swings. Your job is to use his moods. If his price is a fantastic bargain, you buy. If his price is just silly, maybe you sell. And if the price is just meh, you do nothing at all. And this little story brilliantly illustrates where Buffett's real edge comes from. It's not in the spreadsheets, it's behavior. Because at the end of the day, successful investing isn't just about analysis, it is about emotional control. I mean, think about it. Most investors fall into the same predictable traps over and over. They get overconfident when things are good, they chase whatever's hot, they panic and sell everything when prices drop, they stare at their portfolio every 5 minutes and confuse normal market volatility with actual risk. Buffett's entire process is basically designed to avoid these very human traps by building his approach around patience and rational thinking. He acts like a business owner, not a gambler. And maybe most importantly, he plays a completely different time game. See, most people are trying to win this week or this month. Buffett is trying to win over the next few decades. That long-term horizon changes absolutely everything. It lets compounding work its magic. It lets you ignore all the daily noise. It lets you make fewer decisions, but much, much better ones. Okay, so let's put this all together. We can basically boil this entire philosophy down into a practical 6-point checklist that you can use to start thinking more like a business owner. All right, here we go. First, you ask yourself, can I explain what this business actually does simply? Next, does it have a durable advantage, that moat that's going to protect its profits? Third, has it performed consistently for years, not just the last few months? Then you look at the leadership. Do I actually trust this management team to be smart with the company's money? After that, you dig into the financials. Is the company financially strong with healthy profits? And finally, you check the price tag. Am I paying a sensible price for what this business is truly worth? And after all of that, there is one last and maybe the most critical question you have to ask yourself. It's this. If the stock dropped 30% tomorrow, would my first instinct be to buy more or would I panic? That right there, that's the emotional audit, and it matters so much more than people want to admit. Because look, Buffett's method isn't complicated. It's just incredibly hard to follow. It requires you to be calm when everyone else is frantic, to be patient when they're impatient, and to be disciplined when they're all chasing the next hot thing. So if you want the absolute core of the Warren Buffett way in one single sentence, here it is. Buy wonderful businesses run by trustworthy people at sensible prices and then hold them long enough for compounding to do all the heavy lifting for you. That's it. It's not a secret code. It's not a magic indicator. It's just a durable framework applied with relentless consistency.